Here's a number that will crush your confidence. 97% of traders lose money consistently. But here's what's worse. Most think they're destined for the 3% who make it. You're about to discover why Jesse Livermore called position sizing the difference between the quick and the dead, and why a single percentage point separates market legends from market casualties. Picture two traders entering 2022's bear market with identical $100,000 accounts. Same strategy, same timing, same stock picks. Trader A risks 15% per position because bigger bets mean bigger profits. Trader B follows Livermore's iron law: never risk more than 3% per trade. After 5 consecutive losses, which happens to every trader, Trader A has obliterated 55% of his account. Trader B, down just 14%, and still very much alive. Let me show you exactly how this mathematics of survival works in practice. Take Michael, a software engineer who started trading with $50,000 after studying every chart pattern and memorizing every indicator. He believed his analytical skills guaranteed success. His first trade risked $7,500, 15% of his account, on a tech stock breakout he was absolutely certain about. The stock gapped down overnight on earnings disappointment. Michael's stop loss should have triggered at a 6% decline, but he convinced himself it was temporary weakness. The fundamentals haven't changed, he rationalized. What should have been a $450 loss became a $2,100 disaster when he finally capitulated at a 14% decline. Now Michael's account sat at $47,900. To recover that $2,100 loss, he needed a 4.4% gain on his remaining capital. But Michael's psychology was damaged. He felt behind, pressured to recover quickly. His next trade risked $8,000, now 16.7% of his reduced account, because he needed to make back the loss. This is the amateur's death spiral. Each loss increases the percentage needed for recovery. Each recovery attempt increases position size. Each larger position increases emotional pressure. Compare this to Sarah, who started with the same $50,000, but followed Livermore's 3% rule religiously. Her first trade risked exactly $1,500. When the same tech stock gapped down, she honored her stop loss at 6%, taking a $90 loss. Her account, $49,910. To recover that loss, she needed just a 0.18% gain on her next winner. More importantly, Sarah's psychology remained intact. The loss was manageable, expected, routine. She felt no pressure to recover quickly, no urge to increase position size, no emotional damage from the setback. The amateur thinks position sizing is about being conservative. The professional knows it's about mathematical survival. When Livermore lost his first fortune, he learned this lesson in blood. The market doesn't care about your rent money, your conviction, or your need to be right. The difference between Michael and Sarah wasn't skill, knowledge, or market timing. Both used identical strategies. The difference was position sizing, and position sizing determined everything else. Psychology, decision-making, long-term survival. Here's the counterintuitive truth that separates survivors from casualties. The traders who risk the least per trade often accumulate the most wealth. Why? Because they survive long enough to compound their edge. Fear and greed hate numbers. Discipline loves them. When you risk 3% instead of 15%, something profound happens to your nervous system. Your heart rate doesn't spike when positions move against you. Your palms don't sweat when drawdowns develop. Your sleep doesn't suffer when markets gap overnight. You trade your system instead of your emotions. This psychological transformation creates a cascade of professional behaviors. You honor stop losses because they're not catastrophic. You wait for high probability setups because you're not desperate. You let winners develop because you're not afraid of giving back gains. You think in probabilities instead of certainties because you can afford to be wrong. Here's the mathematical reality most traders never grasp. Lose 10% of your capital. you need an 11.1% gain to recover. Lose 20%, you need 25%. Lose 50%, you need 100%. This geometric decay is why most trading accounts die slowly, then suddenly. Let me make this unavoidable with a practical drill. Take your current account balance, multiply by 3%. That number is your maximum loss per trade. Now examine your favorite setup. Where does the structure break? Not where you feel pain, but where the idea is invalidated by price. Measure that distance. Divide your risk by that distance to determine position size. If the share count looks tiny, accept it. If it feels insulting, accept it louder. Over 6 months following their initial losses, Michael's account experienced wild swings, big wins followed by bigger losses, as his position sizes grew increasingly erratic. His emotional state deteriorated with each setback. By December 2021, his $50,000 had shrunk to $23,000. Sarah's account grew steadily to $64,000, not through spectacular wins, but through consistent application of the 3% rule. Her losses were always manageable. Her wins could compound because her capital base remained intact. Her psychology stayed stable because no single trade could destroy her. The amateur believes bigger positions mean bigger profits. The professional knows smaller positions mean bigger long-term wealth. The amateur focuses on individual trade outcomes. The professional focuses on statistical edges over hundreds of trades. The amateur trades to be right. The professional trades to make money. Livermore's genius wasn't in predicting market direction, it was in surviving long enough to capitalize when his predictions proved correct. You might ask, why 3% and not 1% or 5%? The answer is pragmatic. 1% can be too small to pay for enough attempts in certain strategies without starving your winners. 5% invites ruin when volatility clusters and spreads widen. 3% is a practical middle large enough to matter, small enough to survive error, slippage, and surprise. It also forces selectivity. You cannot take every signal when each position claims scarce risk capital. You must cherry pick, demand confirmation, and let obvious trades pass if the tape argues. Scarcity improves judgment. Judgment improves outcomes. But the 3% rule isn't just position sizing. It's a complete psychological framework that transforms how you think, feel, and act in the markets. The hidden power lies not in the mathematics, but in what those mathematics do to your mind. When position size is calibrated correctly, you can afford to sit with temporary pain. When it's wrong, every minute becomes torture. This is what Livermore meant when he said, "The big money is made in the sitting, not the thinking." The path from the 97% to the 3% begins with a single decision, accepting that survival matters more than any individual trade outcome. Everything else, the psychology, the discipline, the long-term wealth flows from that foundational choice. The question isn't whether you're smart enough to join the 3%. The question is whether you're disciplined enough to risk like them. Once you understand how this mathematical framework transforms your psychological state, you'll discover why professionals view stop losses not as failure, but as essential survival equipment. When you risk 3% instead of 15%, something profound happens to your brain chemistry. You stop sweating every tick. You stop checking positions every 5 minutes. You start executing your plan instead of negotiating with your emotions. This transformation is not merely psychological, it's physiological. Your nervous system literally recalibrates when risk becomes manageable. The fight or flight response that destroys most trading accounts simply doesn't activate when survival isn't threatened. This is the hidden power of the 3% rule. It allows you to trade your system instead of your fear. Let me tell you about Sarah, a talented day trader who consistently risked 12% per position. She'd wake up at 5 a.m., check overnight futures, and feel her stomach clench if they were red. By market open, she was already emotionally compromised. Her morning routine was a masterclass in self-torture, and she didn't even realize it. She'd enter a breakout, watch it retrace $800, and immediately start second-guessing everything. Should she cut the loss? Should she add more? Her heart rate would spike, palms would sweat, and she'd make impulsive decisions that had nothing to do with her original thesis. Watch what happened during one of Sarah's typical breakout trades. She identified a perfect setup, a stock consolidating near all-time highs with increasing volume. Her analysis was flawless. Entry at $127.50. Stop at $124.25. Target at $135. Risk-reward ratio of 2.2 to 1. Everything looked perfect on paper. But with $6,000 at risk on her $50,000 account, every tick became a personal attack on her financial future. The stock opened at $127.80, confirming the breakout. Sarah felt vindicated for exactly 30 seconds. Then, profit-taking hit. Price dropped to $127.20. Sarah's small profit evaporated. Her hands started shaking. The stock continued falling $126.90, $126.50, $126.20. Now she was losing money, and the psychological pain was unbearable. Her stop was still distant at $124.25, but her mind was already bargaining. Maybe the breakout was fake. Maybe she should cut the loss now. Maybe she should add to the position because it was obviously oversold. By the time price hit $125.80, still well above her planned stop, Sarah couldn't take it anymore. She sold, taking a $1,700 loss instead of the planned $325 maximum. 30 minutes later, the stock reversed and hit her original target of $135. She watched from the sidelines as her perfect analysis played out exactly as planned, but her emotional management destroyed the outcome. This scenario repeated weekly, slowly bleeding her account despite having a genuine edge. Then Sarah discovered the 3% protocol. Same setups, same market conditions, but now risking only $1,500 instead of $6,000 per trade. The transformation was immediate and dramatic. That same breakout setup appeared 2 weeks later, and this time Sarah risked $1,500 on the identical trade structure. When the stock pulled back from $127.80 to $125.80, she felt nothing. A $1,500 unrealized loss on a $50,000 account was manageable, expected, routine. Her heart rate stayed normal. Her hands stayed steady. Her mind stayed rational. She honored her original stop at $124.25, let the trade develop according to plan. And when the stock reversed to hit $135, she captured the full move for a $2,250 profit. Same analysis, same setup, same market conditions, completely different outcomes because of position sizing. This is what Livermore meant when he said, "The big money is made in the sitting, not the thinking." When position size is calibrated correctly, you can afford to sit with temporary pain. When it's wrong, every minute becomes torture. The neuroscience behind this transformation reveals why most traders fail despite having analytical skills. When you risk large percentages of your capital, your brain interprets each trade as a survival threat. The amygdala hijacks rational decision-making. Cortisol floods your system. Your prefrontal cortex, responsible for planning, analysis, and emotional regulation, goes offline. You literally cannot think clearly when survival instincts activate. But when risk is properly calibrated at 3%, your brain recognizes the situation as manageable. The prefrontal cortex stays engaged. You can process information rationally. You can execute predetermined plans. You can learn from outcomes, rather than just surviving them. This is why professional traders often seem emotionally detached from their positions they've calibrated risk to maintain cognitive function, while amateurs fight their biology and lose to it every time. The professional understands that position sizing is really emotion sizing. Calculate this brutal mathematics. Lose 10% of your capital. You need 11.1% to recover. Lose 25%. You need 33.3%. Lose 50%. You need 100%. This geometric decay is the graveyard where amateur accounts go to die. With Sarah's original 12% risk per trade, 3 consecutive losses would destroy 31% of her account, requiring a 45% gain on remaining capital just to break even. The psychological pressure of needing such large gains creates desperation. Desperation leads to increased position sizes. Increased position sizes create more pressure. It's a death spiral that starts with oversizing. At 3% risk per trade, 3 consecutive losses cost just 8.7% of capital. Recovery requires only a 9.6% gain. This manageable mathematics keeps psychology stable. Stable psychology enables disciplined execution. Disciplined execution allows edges to compound over time. Your position size determines your emotional state. Your emotional state determines your decision quality. Your decision quality determines your long-term results. Most traders focus on entries and exits while ignoring the psychological framework that governs both. Here's a practical protocol that transforms theory into muscle memory. Before each trading session, calculate your maximum risk, 3% of total capital. If you have $50,000, that's $1,500 maximum loss per trade. Now examine your setup. Where does the structure break? Not where you feel pain, but where the idea is invalidated by price action. Measure that distance from entry to stop. Divide your maximum risk by that distance to determine position size. If the share count looks embarrassingly small, accept it. Embarrassing is survivable. Impressive is often fatal. Watch how professionals handle pyramiding, adding to winning positions. The amateur adds to losers, hoping to average down. The professional adds to winners, using profits to increase exposure while maintaining risk discipline. Sarah learned to start with a pilot position, risking 2% of capital. When price confirmed her thesis with volume and momentum, she'd add a second unit, bringing total initial risk to 3%. She'd move the stop on the first unit to break even, so her net risk remained contained while exposure grew with confirmation. This is how you build positions that can survive pullbacks without gutting your composure. Identity shapes behavior in markets more than knowledge or analysis. The amateur believes bigger positions mean bigger profits and treats losses like personal insults, responding with larger bets. The professional knows smaller positions mean bigger long-term wealth and treats losses like overhead, responding with smaller bets or no bets. The amateur focuses on individual trade outcomes and trades to be right. The professional focuses on statistical edges over hundreds of trades and trades to make money. When you risk 3% instead of 15%, you automatically start thinking like a professional because your survival isn't threatened by routine market movements. Your first job is protecting capital. Your second job is protecting capital. Your third job is protecting capital. But capital protection isn't just about preserving money, it's about preserving your psychological state. When you protect your capital through proper position sizing, you also protect your ability to think clearly, act decisively, and maintain discipline under pressure. The 3% rule doesn't just manage financial risk, it manages your nervous system, keeping you in the optimal psychological state for decision-making, while preventing the emotional hijacking that destroys most trading accounts. But how do you know when the market is telling you you're wrong? The amateur's greatest weakness reveals itself not in the entry, but in the exit. When trades move against them, hope becomes a toxic drug, transforming manageable 3% losses into account-destroying 30% disasters. This psychological poison works slowly at first, whispering reasonable justifications for holding losing positions, then accelerates into a full-blown addiction that destroys accounts and careers. Professionals view stop losses not as failure, but as essential survival equipment. They understand that the market is the ultimate arbiter of truth, and when price speaks against their thesis, they listen immediately and act without hesitation. Before entering any trade, you must define your maximum acceptable loss within the 3% framework. If your account holds $50,000, your maximum risk is $1,500, period. No exceptions, no negotiations, no special circumstances. This isn't a suggestion or starting point for negotiation. It's an iron law that governs every decision you make in the markets. Now calculate backward from your stop, not forward to your target. If your stop loss sits 6% below your entry price, you can only buy enough shares so that a 6% move equals $1,500. Take your maximum risk of $1,500 and divide by $6 per share of risk. The answer is 250 shares. This might mean smaller positions than your ego desires, but it guarantees your survival while your ego learns to accept mathematical reality over emotional preferences. Consider Tom, a mechanical engineer who brought analytical precision to everything in his life except his trading exits. He approached the markets with the same methodical thinking that made him successful in his career, spending weeks analyzing a momentum stock that showed perfect breakout characteristics. The setup was textbook consolidation near all-time highs, increasing volume patterns, institutional accumulation signals, and strong relative strength versus the sector. Tom bought at $100 with what he considered a disciplined plan. A mental stop at $94, representing a clean 6% loss that fit within reasonable risk parameters. For exactly 48 hours, everything validated his analysis. The stock pushed to $103, confirming the breakout thesis and making Tom feel like a market wizard. Then reality introduced itself with a vengeance. Price dropped back to $100, erasing his paper profits. Tom felt the first flutter of concern, but reminded himself that pullbacks were normal in strong trends. The stock continued falling $99, $97, $95. When Price approached his predetermined stop at $94, Tom's psychology began its transformation from analytical to emotional. Instead of preparing for his planned exit, he was rationalizing reasons to stay. Just temporary weakness, he told himself. The fundamentals haven't changed. This is probably just profit-taking before the next leg higher. But the tape was screaming otherwise. Volume dried up on any bounce attempts, indicating lack of buying interest. Momentum indicators that had confirmed his entry were now rolling over. The very institutional buying that had attracted him to the trade was now absent, replaced by persistent selling, pressure that grew stronger with each passing hour. By the time Price hit his $94 stop level, Tom's rational mind had been completely hijacked by his emotional system. The planned 6% loss suddenly felt enormous, not because of its actual size, but because of what it represented to his ego. He started bargaining with the market. If it bounces from here, I'll sell on the rally and break even. The bounce never came. Price continued its relentless decline. $92, $89, $85, $80. Each tick lower made selling feel more painful, transforming what should have been a routine business decision into a personal admission of catastrophic failure. Tom watched his planned $600 loss become a $1,200 disaster at $88, then a $2,000 crater at $80, then a devastating $2,800. Account wound when he finally capitulated in panic at $72. His $10,000 position became worth $7,200. What should have been a manageable 6% setback became a 28% account destroyer because he couldn't execute his plan when the market told him he was wrong. This scenario repeats thousands of times daily across every market, in every time frame, with every type of trader. The pattern is always identical. Careful analysis for entry, emotional chaos for exit. Tom's technical analysis was perfect. His entry timing was flawless. His initial position sizing was reasonable, but his exit protocol or lack thereof destroyed everything else. One decision, the decision to hope instead of act, transformed a manageable business expense into a significant psychological and financial wound that would take months to heal, both mathematically and emotionally. Livermore was ruthless with stops because he understood a fundamental truth. Markets are never wrong. Only opinions are wrong. When price action contradicted his thesis, he exited immediately without emotion, argument, or negotiation. He had no attachment to his positions, only to his capital and his process. "It was never my thinking that made big money," he said. "It was always my sitting." But before the sitting came the cutting. Livermore knew that preserving capital was infinitely more important than being right about any individual trade. He understood that small losses were simply the cost of admission to participate in the inevitable winning streaks that made trading profitable. He wasn't afraid to admit temporary error. He was terrified of staying wrong long enough for temporary to become permanent. The 3% rule transforms stop losses from painful admissions of failure into routine business expenses. When you risk only 3% of your capital, a stop loss becomes equivalent to paying rent or buying office supplies, a predictable cost of doing business that enables future profits. At 3% risk per trade, losing feels manageable rather than catastrophic. Your nervous system stays calm. Your thinking remains clear. Your decision-making process stays rational. You can learn from the outcome rather than being emotionally crippled by it. This psychological equilibrium is the foundation that separates professionals from amateurs, survivors from casualties. Here's the mechanical protocol that removes emotion from exit decisions. Before entering any position, write down 3 non-negotiable numbers: your entry price, your stop price, and your exact position size. These numbers represent a contract with yourself that cannot be modified once the trade begins. When price hits your stop level, you sell immediately. No analysis, no second guessing, no hoping for bounces or reversals. The market has rendered its verdict on your thesis, and that verdict is final. Your opinion about fundamentals, future potential, or fair value becomes irrelevant the moment price action contradicts your plan. Use mechanical execution to remove discretion from critical moments. Set price alerts at your stop level so you're notified immediately when action is required. Place stop-loss orders when market conditions allow, understanding that stop market orders guarantee execution, while stop-limit orders protect against slippage, but risk non-execution in fast markets. Accept slippage as the cost of staying solvent if your planned risk is $3 per share. Budget an additional $0.30 for gaps and spreads, then size your position as if the real risk is $3.30. This approach reduces both position size and ego involvement while increasing survival probability. Professional traders create if-then scripts that remove real-time decision-making from exit protocols. If price closes below the pivot low on increasing volume, then sell immediately at market. If the stock breaks its 20-day moving average and fails to reclaim it by the close, then flatten the position. If relative strength versus the sector deteriorates for 3 consecutive sessions, then reduce exposure by half. These predetermined rules eliminate the emotional bargaining that destroys accounts. The decision is made when you're rational, then executed mechanically when you're under stress. Watch how the mathematics work in practice with identical analytical edges, but different position sizing disciplines. Sarah, following the 3% protocol religiously, takes 10 trades over 2 months. 7 lose an average of 2% each, costing her 14% of capital. 3 win an average of 6% each, gaining 18% of capital. Her net result, positive 4% despite a 70% loss rate. Tom, risking 10% per trade with identical setups and timing, loses 70% on his 7 losers and gains 60% on his 3 winners. His net result? Negative 10% with the same analytical edge. The only difference is position sizing and stop-loss discipline. Same market conditions, same entry signals. Completely different outcomes determined solely by exit execution. The identity shift from amateur to professional begins with reframing how you view stop-losses. The amateur sees stops as admissions of personal failure, attacks on their intelligence, or obstacles preventing big profits. Every stopped-out trade feels like a judgment on their analytical ability. The professional sees stops as essential tools for capital preservation, psychological protection devices, and enablers of long-term wealth building. When you can execute stops without emotional damage, You maintain the clear thinking necessary for sustained success. When stops become routine rather than traumatic, you can focus on finding the next high probability setup instead of nursing wounds from the last failure. Your stop belongs where your original idea becomes invalid, not where the loss feels tolerable. Use price structure, not emotional comfort, to determine exit points. Place stops below the pivot low that launched your breakout, under the consolidation base that formed your entry pattern, or beneath the last confirmed higher low in an uptrend. Match stop distance to the natural volatility of your time frame. If you're trading daily charts, don't use stops based on 5-minute noise. Give legitimate setups room to develop while maintaining strict discipline when structural levels break. The 3% rule enables this discipline by making each individual outcome manageable. When no single trade can destroy you, you can afford to be wrong frequently. When you can afford to be wrong, you can execute your rules consistently. When you execute consistently, your edge compounds over time. This is the mathematics of survival that separates the 3% who succeed from the 97% who fail. Small losses, consistently taken, preserve capital for the inevitable winning streaks that create wealth. But what happens when the market gives you no clear signals to act upon? When price action becomes muddy? When trends lose definition? When the tape offers neither confirmation nor invalidation of your thesis? The next principle you must master is perhaps the most difficult for active minds: the art of strategic inaction, where doing nothing becomes your most profitable position. The compulsive amateur believes constant action equals constant profit. This restless energy drives them to scan every tick, chase every breakout, and force trades where none exist. They confuse motion with progress, activity with achievement. Their trading platforms become slot machines, each click promising the next big win, while slowly bleeding their accounts through commissions, slippage, and marginal setups. Professionals understand a profound truth that seems counterintuitive to action-oriented minds. Sometimes the most profitable position is no position at all. Waiting is not weakness. Comes to dazes. Deuces 7. Gumses really 1. 7 peach. Waiting is warfare against your own impulses. Jesse Livermore spent months on the sidelines during certain market conditions, studying what he called the tape, pure price and volume action stripped of opinion, emotion, and wishful thinking. He wasn't idle during these periods. He was hunting. He cataloged patterns, measured volatility, and waited for what he termed pivotal points, those rare moments when market behavior confirmed his analysis with mathematical certainty. The amateur sees Livermore's patience as missed opportunity. The professional recognizes it as capital preservation and psychological preparation. When Livermore finally struck, he did so with accumulated conviction, perfect timing, and precise position sizing. His patience wasn't passive. It was predatory. The tape reveals its secrets only to those willing to wait for confirmation. During unclear market phases, Livermore would reduce activity to near zero, preserving both capital and mental energy for the inevitable periods when trends resumed with clarity. He understood that markets moved in cycles, alternating between trending periods when directional trades prospered and choppy periods when most strategies failed. The amateur tries to profit in all conditions. The professional profits by choosing their conditions. Watch the brutal contrast between two traders with identical starting capital and similar analytical skills. David, a hyperactive day trader, jumped into 15 trades weekly, convinced every fluctuation represented opportunity. His morning routine began at 4 a.m., scanning overnight news, futures, action, and pre-market movers. By market open, he had already identified 6 potential trades. His first position would be a gap fade play, risking 8% of his account because the probability is so high. When that trade moved against him, he'd quickly pivot to a momentum play in a different sector, then a reversal trade when that failed, then an earnings play approaching announcement. David's weekly statistics told the story of slow account death: 15 trades, 47% win rate. average winner of 3.2%, average loser of 4.1%. His gross performance was slightly negative before considering commissions and slippage. More damaging than the financial cost was the mental exhaustion. By Friday, David's decision-making capacity was depleted. He made impulsive trades based on fatigue rather than analysis, compounding his losses while destroying his confidence. Each weekend brought promises to be more selective, but Monday's market open triggered the same compulsive patterns. He was exhausted, stressed, and his account slowly bled through forced setups and marginal decisions. Meanwhile, Maria approached markets with surgical precision, waiting weeks for perfect alignment before risking capital. Her morning routine was equally disciplined, but fundamentally different in focus. Instead of hunting for immediate opportunities, she studied market structure, identified key levels where institutional activity might emerge, and monitored the health of existing trends. She maintained watch lists of high-quality setups, but refused to act until every condition aligned. Clear trend direction, volume confirmation of institutional participation, and risk parameters that fit within her 3% boundary. When these conditions finally converged, usually once or twice per week, Maria would act with absolute conviction and precise position. Sizing. Maria's patience produced dramatically superior results with far less stress. Her typical month included 8 trades with a 62% win rate, average winners of 7.1%, and average losers of 2.8%. Her gross performance was strongly positive before considering the reduced transaction costs from selective trading. More importantly, Maria's psychological state remained stable throughout market cycles. She wasn't exhausted by constant decision-making or emotionally damaged by frequent losses. Her selective approach allowed her to maintain peak analytical performance when opportunities finally presented themselves. This is strategic patience, not passive inaction. When you wait for optimal conditions, you're actively protecting capital by refusing suboptimal opportunities. You're conserving mental energy for high-probability moments, when clear thinking becomes crucial. You're ensuring that when you finally act, every condition favors success, rather than hoping random activity will somehow produce profits. The amateur interprets waiting as missing opportunities. The professional understands that waiting prevents losses while positioning for genuine opportunities. Strategic patience requires recognizing that your brain has limited decision-making capacity. Every trading choice depletes glucose in your prefrontal cortex, the region responsible for rational analysis and emotional regulation. Make 15 trading decisions daily, and your cognitive capacity degrades with each choice. By afternoon, you're literally incapable of the same analytical quality you possessed at market open. Professional traders structure their approach to preserve cognitive resources for the highest probability setups. They make fewer decisions, but make them when their analytical capacity is at peak performance. The 3% rule enables this patience by removing the urgency that drives overtrading. When you know that no single loss can destroy your account, you can afford to wait for perfect setups rather than forcing marginal ones. When you're over-leveraged, every day without action feels like missed opportunity because you need large gains to justify the risks you're taking. This pressure creates a psychological trap where the need for action increases precisely when action becomes most dangerous. The amateur risks large amounts on mediocre setups because they feel behind. The professional risks small amounts on exceptional setups because they can afford to wait for perfection. Livermore called this psychological advantage sitting power, the ability to remain inactive until conditions aligned perfectly with your thesis. He understood that most traders possessed adequate analytical skills, but lacked the emotional discipline to wait for confirmation. They would identify correct market direction but act too early, before institutional participation validated their thesis. They would recognize quality setups but enter before volume confirmed institutional interest. Sitting power meant waiting for the market to prove you right before committing capital, rather than hoping your early entry would be validated by subsequent price action. Here's your practical protocol for developing strategic patience. Create a pre-trade checklist that must be satisfied before any position is initiated. Include technical requirements like trend direction, volume patterns, and momentum confirmation. Add timing requirements like distance from earnings announcements and seasonal patterns. Your checklist should be comprehensive enough that most potential trades fail to qualify. Forcing selectivity while ensuring qualifying trades have multiple factors supporting success. Track your trading frequency and correlate it with performance quality. Most traders discover an inverse relationship between activity level and profitability. Use market conditions to guide activity levels. During strong trending periods, increase your trade frequency because directional strategies have higher success rates. During choppy, range-bound conditions, reduce activity dramatically because most strategies fail in unclear environments. Livermore would sometimes go months without significant positions during unclear market phases. Then deploy substantial capital when trends resumed. This adaptive approach maximizes profits during favorable periods while minimizing losses during unfavorable ones. The identity shift from amateur to professional involves reframing how you view inactivity. The amateur sees waiting as laziness or missed opportunities. Every unused day feels like wasted potential. The professional sees waiting as active capital preservation and strategic positioning for high-probability opportunities. They understand that the market rewards patience more than activity, selectivity more than frequency, quality more than quantity. Professional traders often describe their best years as periods when they traded less, not more. When you combine proper position, sizing with strategic patience, you create a sustainable approach to wealth building that compounds over time. Small risks on high-probability setups, taken only when multiple factors align in your favor, produce consistent profits with manageable psychological stress. The market rewards patience, but only if you can afford to wait. The 3% rule gives you that luxury by ensuring no single outcome can force you into desperate action. But patience alone isn't enough. Once you've waited for the perfect setup and entered with proper sizing, you need a complete framework that governs every aspect of your market participation. How do you synthesize position sizing, stop losses, and strategic patience into a systematic approach that transforms trading from gambling into a sustainable business? Now you understand why Livermore's 3% rule transcends simple position sizing. It's a complete psychological and mathematical system for market survival and long-term wealth building. This isn't merely a risk management technique. It's a comprehensive framework that governs how you think, feel, and act in every market condition. You've discovered how sizing calms the mind, how stops defend the account, and how patience acts like compound interest for your discipline. Now we integrate everything into one cohesive operating system that transforms trading from gambling into a systematic business built on mathematical certainty and psychological stability. The 3% rule creates a cascade of professional behaviors that flow naturally from proper risk calibration, each element reinforcing the others in a powerful success spiral. First, it eliminates fear-based decisions by keeping losses manageable within your psychological comfort zone. When no single trade can destroy your account, survival instincts don't hijack rational decision-making. Second, it preserves capital for compounding during inevitable winning periods. Every dollar not lost to oversized positions becomes available for profitable opportunities when they emerge. Third, it enables strategic patience by removing the pressure to trade frequently or force marginal setups. When you're not over-leveraged, you can afford to wait for perfect alignment. Fourth, it allows intelligent pyramiding into winning positions while maintaining overall risk discipline, letting you build substantial exposure when the market validates your thesis with price and volume confirmation. Remember our opening statistic about the 97% who fail. They fail because they violate every principle we've discussed, creating a destructive cycle that begins with position sizing errors and cascades through every aspect of their trading psychology. Watch this death spiral in action. Excessive risk creates fear because meaningful capital is threatened. Fear creates poor decisions because the amygdala hijacks rational thought processes. Poor decisions create larger losses because emotional choices rarely align with optimal outcomes. Larger losses create desperation because the mathematical hole keeps deepening. Desperation creates even bigger risks. because the need for recovery overwhelms risk management discipline. It's a predictable sequence that destroys accounts regardless of analytical skill or market knowledge. Consider Jennifer, a successful attorney who started with $100,000 and immediately began risking 20% per position. Because bigger positions mean bigger profits. Her first 3 trades were winners, generating quick profits that validated her approach and fed her overconfidence. Position sizes grew to 25%, then 30% as she chased larger gains. When the inevitable losing streak arrived, 4 consecutive losses that happened to every trader, Jennifer's account cratered from $130,000 to $31,000 in just 2 weeks. The mathematical recovery requirements became impossible. She needed a 319% gain on remaining capital just to break even. Desperation set in. Position sizes increased to 50% of remaining capital. Within another month, her account was destroyed. Professionals break this destructive cycle by starting with the 3% foundation and building every decision around that constraint. Manageable risk creates calm minds because survival isn't threatened by routine market movements. Calm minds make disciplined decisions because rational thought processes remain engaged. Disciplined decisions create consistent profits because systematic approaches compound over time. Consistent profits build genuine confidence based on actual results rather than hope. Confidence enables patient, selective risk-taking because there's no pressure to force marginal opportunities. Marcus started with the same $100,000 as Jennifer, but implemented the 3% framework from day one. His maximum risk per trade was $3,000, forcing smaller position sizes but enabling psychological stability. When his first losing streak arrived, the same 4 consecutive losses that destroyed Jennifer, Marcus lost just $11,200, leaving him with $88,800 and intact psychology. Recovery required only a 12.6% gain, easily achievable through normal trading activity. More importantly, Marcus's confidence remained stable because the losses were expected, planned, and manageable. He continued executing his system without emotional interference, and within 3 months had recovered the losses and achieved new account highs. Your implementation protocol must be non-negotiable and systematic. Never risk more than 3% of total capital on any single trade, regardless of conviction level, setup quality, or recent performance. This isn't a guideline, it's an absolute limit that governs every position. Calculate position size before calculating profit targets, ensuring risk management drives sizing rather than profit desires. Execute stops mechanically without discretion, emotion, or second guessing. They're survival tools designed to preserve capital and psychology, not suggestions to be ignored when convenient. Wait for setups, meeting your complete criteria, even if it means trading less frequently than your ego desires. Add to winners systematically, never to losers emotionally. When the market validates your thesis through price and volume action, increase exposure using profits as funding while maintaining overall risk discipline. Build this discipline into your daily calendar with structured activity levels. Designate A days, when the tape trends cleanly, breadth supports your direction, and volatility remains friendly. On A days, you can deploy up to 2 risk units across positions. Designate B days when evidence is mixed. Trade half size with only 1 position maximum. Designate C days when the tape is muddy. Abstain completely. Waiting is a position. Flat is a position. Cash is a position. This cadence preserves capital and mental energy for days that actually pay. Let's ground this with a practical scenario. You track a leading stock forming a tight 3-week base after a strong run, while the started ASIN sector leads and the market shows breadth thrust. Your entry triggers on a heavy volume breakout above resistance. Your stop sits below the base low, representing $3 risk per share. With a $100,000 account and 3% maximum risk, you can afford $3,000 loss maximum. So 1,000 shares represents your ceiling. You start with 600 shares, risking 2% of capital. The stock pushes 2% higher and holds gains on persistent volume. You add 300 shares, bringing total risk to 3%, while raising the first unit's stop to break even. A week later, the stock advances 6% from entry. You lift stops under the rising 10-day moving average and commit to sell half if the stock closes below that line on higher volume. This is controlled aggression. Risk small, confirm, then press systematically. Notice the nested safeguards, protecting you from different failure modes. Sizing controls emotion by keeping individual outcomes manageable. Stops control loss by defining maximum acceptable damage. Confirmation controls timing by requiring market validation before action. Pyramiding controls exposure by ensuring most capital rides when odds lean hardest in your favor. You don't need to be right often if your losses are tiny, and your winners expand under disciplined rules. The identity transformation from amateur to professional begins with recognizing that trading is fundamentally a business, not entertainment. Every day, you decide whether you're the amateur who chases excitement and trades to be right, or the professional who manages risk and trades to get paid. Write your identity as a pledge. I am a risk manager first, a trader second. I protect capital before pursuing profit. I wait for confirmation. I pyramid only into strength. Gaston Geston. Bicing. Gaston Geston. Gaston Geston. I cut losses without debate. Read it before market open. Read it after the close. Rehearse the identity you want until it becomes your default under pressure. The mathematics of this approach become compelling over time. Assume a 55% win rate with average winners of 6% and average losers of 2.8% using the 3% framework. Over 100 trades, you'd have 55 winners generating 330% gross gains and 45 losers costing 126% in losses. Net result, 204% gain on capital, more than tripling your account through modest accuracy and proper risk management. The same win rate with 15% position sizing would require perfect execution to avoid ruin, and a single emotional hold could destroy months of gains. Use a daily scorecard to hardwire professional habits. Grade each trade on 4 metrics: risk adherence, entry quality, pyramiding discipline, and exit execution. A perfect loser: full compliance with plan, clean stop execution, no slippage beyond parameters, represents a process win. A sloppy winner: oversized entry, late stop, random pyramiding represents a process loss. Pay yourself only for process compliance, not outcomes. This rewires your incentive system away from gambling toward professionalism. Your actionable recap is simple and non-negotiable. Cut losses fast, size positions small, wait for your pitch, and own your process completely. The path to the 3% isn't about being right more often than others. It's about being wrong less expensively and right more profitably. It's about prioritizing survival over heroics, discipline over daring, and systematic process over speculative prediction. Master these principles, and you'll discover why Jesse Livermore called position sizing the difference between the quick and the dead. If you've learned how disciplined risk management transforms trading psychology, the next lesson on reading pure price and volume action will deepen your edge by teaching you to recognize the pivotal points where institutional money reveals its true intentions.